Preamble title, Plus Taxes When You Retire Abroad, FBAR, FATCA, and the $10,000 Mistake to Avoid, 2026, keyword, US Taxes Abroad, FBAR, FATCA Retirement. Now, Hook 00030T. The IRS collected $376 in our penalties last year from Americans living abroad, and a large portion of those penalties came from retirees who didn't even know the rule existed. Not offshore tax evasion, not fraud. Wow. Just people who moved to Mexico or Panama, opened a local checking account to pay rent, and had no idea that account triggered a federal reporting requirement with a $10,000 per account penalty for getting it wrong. If you're thinking about retiring to Latin America, or you already made the move, the U.S. tax system did not let you go. Today, we're going through exactly what it wants from you in 2026. FBAR, FATCA, how your Social Security gets taxed, what the Foreign Earned Income Exclusion actually does, and who it's almost completely useless for, and the state tax trap that blindsides people every single year. Premise 03010. By the end of this video, you'll know whether you still owe us taxes at all, what FBAR and FATCA actually require, and how to stay compliant, how Social Security gets taxed when you're living in Medellin or Mexico City, whether the Foreign Earned Income Exclusion applies to your retirement income, and the honest answer there surprises most people, and how to properly sever your state tax. I'm not a CPA, and you should absolutely work with one who specializes in expats. But after this, you'll know the right questions to ask. And he said so. Best Section 1. You still owe us taxes. Here's why 230TO. Here's the foundational fact that surprises retirees every time. The United States taxes you based on citizenship, not where you live. Almost every other country on Earth taxes you based on residency. The US and Eritrea are the only two countries in the world that follow you with a tax bill, no matter where you move. So if you're a US citizen or green card holder and you retire to Mexico City, Panama City, or Medellin, you still file a US federal tax return every single year. That doesn't mean you'll owe a lot. For many retirees living modestly abroad, the actual tax bill is small or zero. But the filing obligation doesn't disappear when your flight lands. The standard filing threshold in 2026 is about $14,600 for single filers and $29,200 for married filing jointly, same framework as living stateside. If your total income is under that, you may not need to file. But most retirees receiving Social Security plus any investment income will cross that line easily. Plan on filing. Now, Section 2. FBAR. The $10,000 rule nobody warned you about. 230-430. This is where people get financially hurt, and it happens quietly. FBAR stands for Foreign Bank Account Report. B. The rule. If you have foreign financial accounts, checking, savings, brokerage, a foreign pension fund, and the aggregate balance exceeds $10,000 at any single point during the year, you must file FinCEN Form 114. Not with your tax return, separately, through the BSA e-filing system on the U.S. Treasury's website. The deadline is April 15, with an automatic extension to October 15, if you need it. The penalty structure is what makes this dangerous. Non-willful violation, meaning you genuinely didn't know, can cost up to $10,000 per account per year. Willful violation is the greater of $100,000 or 50% of the account balance per violation per year, plus potential criminal exposure. We're talking about accounts like a basic checking account at Bancomer in Mexico or Banco Nacional de Panama, the kind you open to pay your landlord. Two things to know about the $10,000 threshold. First, it's aggregate. If you have 3 accounts with $4,000 each, $12,000 total, all 3 need to be reported, even though each one individually is under the threshold. Second, it's any point during the year, not just December 31. If you had $11,000 in April and drew it down to $3,000 by year-end, you still had to file. If you're already abroad and realize you missed prior years, don't panic yet. The IRS runs a program called Streamlined Filing Compliance Procedures specifically for Americans living overseas who fell behind unintentionally. You file the delinquent returns, pay a small miscellaneous offshore penalty. For foreign residents, this can sometimes come out to $0, and you're back in compliance. Many expat CPAs do this regularly. The program exists because Congress acknowledged that awareness was genuinely low. Section 3, FATCA, Form 8938, the other one 43545. FATCA, the Foreign Account Tax Compliance Act, created a parallel reporting requirement called Form 8938. Same general concept as BAR, different thresholds, different agency, filed differently. Form 8938 goes with your actual tax return, your Form 1040, not separately. The thresholds are higher. If you're single and living abroad, you file Form 8938 if your foreign financial assets exceed $200,000 on the last day of the year, or $300,000 at any point during the year. Married filing jointly abroad, $400,000 and $600,000 respectively. The frustrating part, you may need to report the same account on both FBAR and Form 8000. They are not the same form, they are not filed the same way, and one does not substitute for the other. If both thresholds apply, file both. An expat CPA handles this routinely. It's one of the main reasons you want someone who does this specifically, not a general tax preparer who sees one expat client a year. Section 4. How your Social Security gets taxed when you're living abroad. 545, 730T. Good news first. Your Social Security keeps coming. The U.S. will direct deposit to most international accounts or to a U.S. account you access abroad via ATM or transfer. The countries where the U.S. government actually refuses to send payments: North Korea, Cuba, a few others. No major Latin retirement destination makes that list. Panama, Mexico, Colombia, Ecuador, Uruguay, Peru, all clear duh. Now the complicated part. Social Security benefits can still be federally taxable even when you live abroad. The IRS calculates it using combined income, your adjusted gross income, plus any non-taxable interest, plus 50% of your Social Security benefit. If that number lands between $25,000 and $34,000 as a single filer, or $32,000 to $44,000 married filing jointly, up to 50% of your Social Security is taxable. Above those thresholds, up to 85% is taxable. For many retirees living on $1,600 to $2,000 per month in a lower-cost LATAM city, their combined income actually falls below the $25,000 threshold, meaning zero federal tax on their Social Security. That's a real benefit of the lower cost of living that most people don't think about until they run the numbers. Quick note on tax treaties. Mexico has a comprehensive income tax treaty with the United States. Most other major LATAM retirement destinations, Panama, Colombia, Ecuador, Peru, Costa Rica, Uruguay, do not. A tax treaty primarily affects how income gets treated in the local country for foreign residents. It doesn't usually change your U.S. filing obligation, but it matters for planning if you have significant investment or pension income. If Mexico is in your shortlist, that treaty is worth discussing with your CPA. Section 5. The Foreign Earned Income Exclusion, who it actually helps, 739.15. This is the most misunderstood tax benefit for Americans abroad, and I want to be direct. For most pure retirees, the Foreign Earned Income Exclusion doesn't apply to your retirement income. The FAI, filed on Form 2555, lets you exclude approximately $130,500 in 2026 from your U.S. taxable income. That number adjusts annually for inflation. Sounds incredible. Here's the catch. It only applies to earned income, wages from a job, net self-employment income, freelance work. It does not apply to Social Security. It does not apply to 401k or IRA withdrawals. It does not apply to pension income, dividends, capital gains, or rental income. If your retirement is funded entirely by those sources, which describes the majority of retirees, the fee does nothing for you. Where it genuinely matters, if you do any part-time consulting, remote work, or freelancing in retirement, that earned income qualifies. A retiree who earns $50,000 per year doing remote consulting from Mexico City, while also collecting Social Security, could potentially exclude that entire $50,000 from a federal tax. That's real money. To qualify, you need to meet either the physical presence test, 330 or more days, outside the U.S. in any 12-month period, or the bona fide residence test, meaning you've established genuine foreign residency. Your expat CPA will know which test applies to your situation. Section 6. The State Tax Trap, 9-15-10-45. When you move abroad, federal rules govern your federal tax situation. State taxes work differently, and some states are aggressively unwilling to let you go. California is the most well-known example. California's position is that once you were a California resident, you need to affirmatively establish a new domicile somewhere else before the state stops taxing you. Moving to Oaxaca doesn't automatically do it. California's Franchise Tax Board has audited expats years after they left, arguing the person never properly severed state residency. What severing residency looks like in practice. Getting a driver's license in a different U.S. state before you leave, registering to vote elsewhere, closing California-based accounts, changing all mailing addresses, and having documentation of your new foreign address. Done correctly, you stop owing California state income tax entirely. Done sloppily, they'll send you a bill calculated on your full income, including your Social Security, for years. Other states with aggressive domicile tracking: New Mexico, South Carolina, Virginia. Most states are not like this. If you move abroad cleanly with no remaining ties, they're not pursuing you. But if California was your home state, this planning step is worth a specific conversation with a CPA or tax attorney before you book the movers. Cross vehicles 11-0-12-15L. The honest picture. On the positive side, FBAR and FATCA are reporting requirements, paperwork, not new taxes. If you're not hiding anything, the only real risk is ignorance. And now you have the map. Many retirees living on Social Security as their primary income find their effective U.S. tax burden actually drops when they move abroad, because lower living costs mean lower combined income, and the tax formula works in their favor. The streamlined filing procedures give you a genuine path to catch up if you're behind. And if you do any part-time work, the fee is a legitimate and powerful tool. On the challenging side, the compliance load is real and it doesn't simplify over time. You need an expat CPA, not a general accountant who files one expat return a year. Expect to pay $600 to $1,500 annually for that. Most major Latin destinations lack a U.S. tax treaty, which limits your planning options compared to, say, retiring in Mexico. And the state tax issue is a planning task that needs to happen before you leave, not after you've already established your life abroad. FT 12, 15, 13, 0 view. What's your biggest tax question about retiring abroad? Social Security exposure. Whether you need to file FBAR. The state residency question? Drop it in the comments. I read everyone. And your question shapes what we cover next. If this gave you something useful, subscribe and hit the bell. We cover the financial mechanics of retiring in Latin America that most financial advisors don't bring up until you're already on the plane. And there's a lot more coming. Otro 13, 0, 13, 30Q. Next video. Wire transfer fees are quietly eating your retirement income every month. The average bank charges $35 to $50 per international wire. Wise charges $12 on the same transfer. We're going through the exact side-by-side comparison, every major option, and why most banks are still getting away with it. See you there.